Hi folks, this is Craig, the options linebacker, and this is the weekend report for Sunday, October 25th. Let's start off this weekend's report by looking at a couple of different indices. I've got the Dow 30 on the left-hand side, and I've got the Russell 2000 small caps on the right-hand side. So we're comparing the big caps versus the small caps. And the Dow has come off, a very strong rally here, 56%, but is appearing to stall after hitting higher highs. Now, what's this yellow line that's up here that it's stalling under? Well, that's the daily pivot from the crash back in October of 2008. So this looks like this type of pattern where it comes down here, establishes support, bounces higher, and then comes back down through that. So that's a 1, 2, 3 breakdown pivot. And those can be very, very strong overhead targets. Now, they do attract price up to them, but once they hit that level, it can be tough to get through. As we look at the Russell 2000, it's even stronger because we have a triple bottom there in 2008 when it finally broke through on the crash. That's obviously a huge overhead target with a lot of overhead supply. Now, a lot of times the Russell and the NASDAQ can be the leaders off the bottom as they were back in March and April, with an 82% rally. That's amazing. That just shows how beaten up the small cap stocks were by the time we got to last March. By the same token, they can also be kind of a canary in the coal mine when things are starting to get tired. What you see is that the speculative small cap stocks, which are less liquid, so are tougher for the fund managers to rotate out of very quietly and surreptitiously, the retail crowd starts to chase after the big caps, which are your big names like the GEs and so forth. Now, what we talked about last week was I expected to see a little bit of weakness, a little bit of softness come into the market, at least in the short term. Now, that hasn't changed. I still expect at some point higher prices, probably by the end of this year, but these charts are ripe for at least a pullback to generate some negativity in the charts again and create yet another short squeeze, which is really how this chart's been powering higher all the way through here. Each one of these were short squeezes by too many traders being on the wrong side of the market. Now let's move over to the S&P 500, which is my favorite chart for looking at the market. We have come from a higher high back in 2007 to a lower low earlier this year in March. And so we are not going to get a higher high out of this move on the monthly chart. It just won't happen. What we'll see first is we'll see a lower high. Now, this is where we're waiting for the monthly chart to show us when this lower high will come in. This will start on the weekly chart, but for right now, we have the beginnings of a little bit of a shooting star coming here with yet a week left to trade in October. Now, at some point, whenever it does happen, we will see about at least a 38.2% retracement in the monthly chart. And that's going to feel like an absolute panic after this 7-month rally going straight up off the bottom. People are not going to know how to deal with it. And right now, that 38.2% retracement is all the way down here at S&P 934. So you can imagine if we dropped 140, 50 points right now, what that would feel like in the S&Ps. The market would be panicking, but that would be just a normal pullback in the S&P monthly chart. We know that some kind of a pullback will come at some point. What matters is what happens after that pullback starts, whether or not it keeps on going past the 61.8% retracement or forms a higher low and starts to head higher again. But we're months away from that decision point. So for now, all the action really is at the weekly chart. The weekly chart is showing an enormous amount of confluence overhead as far as resistance. We have this descending trend line, which has marked all the significant highs through the bear market since October 2007. We have the 50% fib retracement of the bear market up here at 1121. We also have the daily breakdown pivot, which was right around 1100, which we've just tagged this past week. So all of these things are conspiring to put some negative pressure on this index and get people to take profits early. And we'll see whether or not that'll turn into a little bit more negativity with a few more weeks down, such as what we got last June, which again will get people on the wrong side of the trade being too bearish, and then some positive catalyst will come along and give us our next wave up. Now, our primary weapon to play this market over the past 4 years has been the Iron Condor. What this is a bearish options trade. So as long as the price closes below this point in November, we're in good shape. And then we have a bullish options trade down here. As long as the price closes above here for November, we're in good shape as well too. So I actually like where we are right now because we have that strong overhead resistance at 1100. We have that descending trend line in play there. And it looks like we may be drifting a little bit lower to test support yet again. So we are a little closer to the upside, or the bear call spread that's up here, but that's what you want. You want it to be somewhat more biased towards the upside because prices move so much faster to the downside and give you less time to react to that. So we play these Iron Condor spreads based on high probability. We try to set these up for at least a 90% chance of winning for the month, and we use technical analysis for these, and they're both looking very good right now. Both have over a 90% chance of success for November expiration. Now, another style of Iron Condor trade that we play is based on the Greeks. We call this the delta neutral Iron Condor. These are played somewhat closer to the money than the high probability trade. So we're playing these for a 30 delta strikes on the calls and the puts. So we play closer to the money, but we have a 1-to-1 risk reward. Now we have a kind of an odd looking P&L graph for the month of November because we had to butterfly off or hedge the upper call spread. So the price had moved up near the top call spread, so we added a bull call spread, hedging spread to this, and it gives us kind of a unique P&L, but what it does is it cuts down our topside risk on here while still allowing ourselves to profit on this trade. So this one is actually going very well, and the current price right now is well within the confines of the Iron Condor. Now, with the amazing rally that we've had since March, you don't want to fight a market like that. So when in Rome, do as the Romans do. Something that we've been doing since this summer is playing more swing strategies, looking to take more short-term profits off of directional strength. And one of these strategies is the 7-7 strategy, where we're looking to buy a 7-day low and sell off at a 7-day high. We had a signal a couple weeks back on the SLV here, and we were in the trade for about a week, and I just exited on Friday as we made an intraday 7-day high, and that was good enough for me. I didn't want to wait for the close because when you come up against resistance like this, you take a gift when you see it. Lastly, the next big event risk that we have coming up in the markets is going to be the FOMC release on November 4th. So this happens every 6 weeks, and it always generates huge amounts of volatility in the market when the policy release comes out at 2:15 Eastern Time. We always recommend that traders become a little bit more nimble and perhaps lighten up their position size a little bit in advance of an event such as this. So that's it for this weekend, and thanks for watching. Make sure that you tune in next week for more in the markets. Really quick before you go, we just released a new product called Traders Fast Track, which is an inexpensive trading success program. If you go to the link in blue, we have a special offer where you can get our premium daily newsletter free for a whole month at optionslinebacker.com/fasttrack2. We also have some brand new free stuff for you. When you go to that Fast Track page, you can sign up for a free monthly newsletter dedicated to how successful traders operate, our Fast Track newsletter. You can also instantly download our brand new ebook for free, Technical Analysis for Options Traders, which shows you how a few simple yet powerful reads in the market can help improve your options trading profitability. Good trading. See you next week.